I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. The S&P 500 is, I don't know whether it's 80% of the market value of, of everything you can buy in this country, and it's over, I think it's over 20 trillion, and you're buying America. And let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. We had 3 shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure to what it would be worth today.
Oh man!
Well, it's
okay.
I just want your audience to think for a second.
Okay.
The answer is about $400,000. So if I, as a little kid, had taken that $114 I'd saved to shovel snow or whatever I'd done, $400,000 today in one person's lifetime. That's America. That isn't me. It is the huge tailwind the American economy gives to any equity investor. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. It looked like we were losing the war when we first bought it. But America is a powerful economic machine that since 1776 has worked, and it's going to keep working now. You don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees than what I'm talking about.
Yes.
Yeah.
And there's no reason to think that we don't know if it's 400,000, but that same sort of process or returns won't happen starting right now.
The S&P 500 companies have earned well over 10% on equity, often 15% annually for years and years and years and years. They've done it with Democratic administrations, with Republican administrations. Now, you get money compounding at that kind of rate underlying your investment, and you get a diversified group of that. I mean, you're going to do well.
If the people in this room owned all of the farmland in the United States, and you offered me a 1% interest in it, and you said, for a 1% interest in all the farmland in the United States, pay our group. Let's see. It says bargain price, $25 billion. I'll write you a check this afternoon. $25 billion. Now I own 1% of the farmland. If you tell me you own 1% of the apartment houses in the United States, and you offer me a 1% interest, so I'll have a 1% interest in all the apartment houses in the country, and you want whatever it may be for it, and call them another $25 billion or something. I'll write you a check. It's very simple. Now, if you told me you owned all of the Bitcoin in the world, and you offered it to me for $25. I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, maybe I have the same people, but it isn't going to do anything. The apartments are going to produce rental, and the farms are going to produce food. And if I've got all the Bitcoin, I'm back where whatever his name was, who may or may not have existed, was 15 years ago. If I've got it all, he could create a mystery about it. But everybody knows what I'm like. I mean, so if I'm trying to get rid of it, people will say, well, why should I buy some Bitcoin from you? I mean, why don't you call it Buffett coin? Make your own or something. What? Do something. But I'm not going to give you anything for it. And you'd be right, incidentally. But that explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got. Now,
there can be all kinds of companies that have wonderful futures, but I don't know which ones they are. I've given talks in the past where I carry with me a 70-page, tightly printed list, and it shows 2,000 auto companies. Now, if at the start of the 20th century, you had seen what the auto was going to do to this country, the impact it would have on the lives of then your children and grandchildren and so on. It transformed the American landscape. But if those 2,000 companies, 3 basically survive, and they haven't done that well many times. So how do you pick 3 winners out of 2,000? I mean, it's not so easy to do. It's easy when you look back, but it's not so easy looking forward. So you could have been dead right on the fact that the auto industry, in fact, you probably couldn't have predicted how big an impact it would have. But you wouldn't have, if you'd bought companies across the board, you wouldn't have made any money, because the economic characteristics of that business were not easy to define. I've always said the easier thing to do is figure out who loses. And what you really should have done in 1905 or so, when you saw what was going to happen with the auto, is you should have gone short horses. There were 20 million horses in 1900, and there's about 4 million horses now. So it's easy to figure out the losers. The loser is the horse. But the winner was the auto overall. But 2,000 companies just about failed. A few merged out and so on. There were 3 companies, auto companies, in the Dow Industrials in the 1920s and 30s. Studebaker, Nash Kelvinator, and Hudson Motor. Now, those names are all familiar to me, and maybe some of them are familiar to you, but they're not making any cars. They didn't make money, and yet at one time, they were in the Dow 30. They were the aristocrats of American business, and they got creamed. So figuring out the economic characteristics of the winners in a wonderful business is not easy.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. And there are many take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned, because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it'd be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If we do that, the shareholder, whether they're taxable or whether they're not taxable, whether they're a foundation or whether they're living on income even, they are better off if we retain the money, because if they were going to get $1 in dividends and it became worth $1.10 or $1.20 in market value immediately on a present value basis, they're better off selling a small percentage of their stock and realizing the required amount that way, and they will have more money when they get all through doing that than if we paid it in dividends. But if the time comes, and it will come someday, if the time comes when we don't think we can use the money effectively to create more than $1 of market value per dollar retained, then it should be paid out. And like I say, we do that individually within Berkshire. But because we have this ability to redistribute money in a tax-efficient way within the company, we probably had more reason to retain all of our earnings. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire. We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any of it.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you really gotta grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.